Thanks for coming. I'm Ryan Belcher. This is Wayne Thacker. We're from Comprehensive Financial. I think we've talked to most of you in the room here. We do the retirement plan, 403B, 401A plan for the school system here. And then today's workshop is really just meant to be kind of an overview of your retirement benefits, how they work, the things you need to be thinking about as you approach retirement, and then ultimately kind of the decisions you have to make when you go into retirement and further. So without further ado, so the screen obviously is not super clear. You all should have a handout if you can kind of follow along. I think this slide is just really meant to kind of show that sometimes you don't know what you don't know. I mean, Wayne and I have helped literally thousands of people go through this retirement process. You all have never retired before, most likely. So there's just a lot to it. There's a lot of things you got to be thinking about, and a lot of decisions you're gonna have to make. And that's why we do these workshops, and that's why you also are able to meet with Wayne and I one-on-one to kind of help you decide how your stuff works and decide what you should do with your different options that you have. We pretty much specialize in working with public employees, teachers, and other public employees. That's kind of what we cut our teeth doing, and really become experts in that arena. So these are all a lot of different terms that you're going to hear and things you got to think about when you're thinking about retirement. Your pension, your annuity account, your Social Security, your 403B, Roth accounts, VIBA, insurance, wills, trusts, beneficiaries, estate planning, all that stuff. So we're going to try to kind of help you figure out how all this stuff works. We do a more in-depth class on some of this stuff, typically we have an affiliation with Ivy Tech, and we do it specifically for public employees, but we typically do it at our learning center down in Bloomington at our office. But we will send out information on that. It's a 3-hour class, and it really takes a deeper dive into some of these topics. Today we're just going to kind of focus on the teacher and Franklin plans, but that's something to look for if you're interested in taking a deeper dive. We'll probably do that, what do you think, in April or May?
Actually, the next one's scheduled for the fall.
For the fall, okay. So one of those will be coming up in the fall. All right, are you going to do any of this?
Right, you got it.
So we like to talk about the three-legged stool of retirement. There's really 3 different parts to your retirement. That's your pension through the state of Indiana, your Social Security, and then your savings. And the savings is your 403B, your annuity savings plan with the state, and any money that you save in other sources for retirement. We're going to start off by talking about your teacher retirement and PERF benefits. So it's kind of now all under the INPRS umbrella. In the past, it's always been TURF and PERF. TURF for teachers, PERF for public employees. It's really now all one thing under INPRS. But it's a 2-part benefit. So there's a monthly pension benefit that you are going to be eligible to receive, and that is based off your years of service. And you got to have a minimum of 10 years of service to be vested in the monthly pension benefit. And then there's also what is now called a defined contribution account, or a DC account. It always has been called the annuity savings account. That's still what we call it, but they recently kind of rebranded that. But it's just a lump sum of money that you have an option with, at retirement. To be vested in the pension so that you can retire and immediately start collecting a pension, you have to meet one of these rules, and it's either the rule of 75 or the rule of 85. And basically, if you're under the age of 60, then it's going to be the rule of 85. So if it's your age plus your years of service. If you're 55 with 30 years of service, 55 and 30 is 85, you can immediately retire and start collecting your pension benefit. Once you get to 60, you got to have 15 years of service to retire, and once you get to 65, you got to have 10 years to retire and immediately start collecting that pension benefit.
I think that's a misprinted slide there. It should say age 65 plus on one of those.
Yeah. So it's double.
Question about that. You said the rule of 85 applied to those who were under 60?
Correct.
Right now, or when they retire?
When they retire, yeah. Yeah, so if you're 59 and you've got, you know, whatever that would be, 26 years of service, you qualify for 59, you have 25 years, you gotta wait until 60 basically to, you know, to retire with immediate benefits. You can, there's been times in the past where we've had people that have, you know, left and done something else or just quit, you know, before they met these rules, and then once you become age eligible, you can still collect at that point in time. You know, so let's say you're 60, or let's say you're 58 and you have 15 years of service. You don't meet the rule of 85, and you're not 60 yet, but if you left at 58, you just have 2 years before you can then file and begin collecting your pension benefit.
So if someone is under 60 now, but say a few years they hit 61, they decide to retire, and they've got, you know, 20 years of service or
Yep.
whatever, they'd be fully vested.
You'd be vested in pension. Yep, that's right. So now the amount that you can receive is still based on your years of service. So the more years you have, the more it's going to be. This is the formula right here. So it's your years of service times your 5 highest years average salary times 1.1%. That's the formula. And that formula gives you what they call your straight life benefit. So, well, we'll get to that. So there's two decisions you have to make at retirement. And one is, do you take a survivor benefit on your pension, and the other is what you do with your money in the DC account. So that formula I gave you, the 1.1% times average 5 times years of service, that gives you this, the straight life pension benefit. And if you elect that option at retirement, that means you're going to get that amount of money every month for the rest of your life, but it's payable for your life only. You have an option of adding a survivor. So a spouse, a significant other, really anyone can be a survivor. But based on your age of retirement and the survivor's age when you retire, they're going to reduce your pension if you select one of these survivor options. This was a real life example. So this was a person that was retiring, and based on that formula, they could have got $2,000 a month as a straight life benefit. But had they taken a 100% survivor, they were only going to get $1,620 a month. But then if they passed first, their survivor would still get that $1,620 a month. There's also a 66 2/3 and a 50% survivor, so a smaller reduction, but then the survivor only gets part of what you were getting if you predeceased the survivor. Now, again, you know, these numbers are based on your age at retirement and your survivor's age. So if your survivor is younger than you, there's going to be a bigger reduction than if they're the same age or potentially, you know, older than you, because they're just doing an actuarial calculation to figure out, you know, what they have to pay for 2 lives versus just 1 life. Any questions on that? That's usually something that brings up some questions.
So is that hypothetical, they're pretty close to the same age?
I think in this case, maybe the survivor was a little bit younger. The ones I've seen recently haven't been quite as big of a drop. You know, maybe it's been $150 or $200 difference for the survivor. But this is something that, you know, when you're planning for retirement, we can go on to the Teacher Retirement website. You've got to get a username and password, and we'll go over that in a minute. But we can go on and kind of run these calculations based on your situation, you know, your years of service, your survivor's birth date, and you can, you know, look at those numbers to see which option is going to make the most sense for you.
So all of the stuff that you're talking about is if you're certified staff.
Either way, so if you're
But I don't think I have a
non-certified,
pension.
well, if you're non-certified, if you're part of PERF, then you still would.
Okay, so that would still
It
apply.
would still apply.
Okay.
Yep, it would still apply. Same formula, you know, your 5 highest years of salary average, your 5 highest years of total pay average, times years of service times 1.1%. I'm not going to spend a lot of time on this. So this is really a concept, and we call it pension maximization, but there's some thought that it's something to look into before you retire, before you make these decisions. But basically what you're doing, if you take this survivor option, you are essentially paying, you know, $380 a month for insurance that if you die first, your spouse still, or your survivor still gets to collect that pension benefit. You know, we've seen some cases where it made more sense, instead of taking a survivor, for the person to actually just go buy a life insurance policy, take the bigger amount of monthly benefit, take some of that money and just buy a life insurance policy instead of doing the, survivor benefit. And that way, if they die, their family, whether that's their spouse or their kids or whomever, gets a lump sum of tax-free life insurance money. So that's just something that you might look at before you just make that, that decision. Okay, so that was just the pension we were talking about. The second part of the INPRS account is the annuity savings account, I'm still gonna call it. The way that works, there's 3% of your salary going into that each year. So it's money that's going into an account, and while you're working, you decide how that money's invested. So there's a stable value fund. It used to always be called the guaranteed fund. That's like the fixed account or the really safe option. And then there's these other, investment funds that you can pick from. The only thing I'm going to say about that is the stable value fund, the guaranteed fund, that used to be the default option years ago. And we still see a lot of people that just never change it. Their money's always been in that. And there was a time when it paid pretty decent interest. Now, it doesn't pay that great. It's a couple % interest. And that may be the best place for your money to be, depending on your situation, but it may not be. So that's just something you want to, reevaluate from time to time, and especially as you get closer to retirement. You want to make sure you're invested appropriately for your situation, and everybody's in a different boat. Now the default is a target date fund, where it's really an age-based plan. Some of it's more aggressive, some of it's safer, and then it kind of changes for you over time as you approach retirement. When you retire, you have two options with the ASA account. You take it as a lump sum. You can either roll it over to another retirement account or just cash it out. Typically, cashing it out is not the best option because it's considered income if you cash it out, and you get nailed with taxes on the whole thing, and it can put you in a higher tax bracket. Or you can essentially combine it with your pension and receive a second monthly pension benefit. Used to be, they literally just rolled that annuity into your first pension, and you got one pension check, you would just get a higher amount. They have now outsourced that to MetLife, and honestly, the rate that they pay it out is not nearly as good as it used to be. So this isn't nearly as popular an option as it once was. But basically, the decision tree here is, if you take it as a lump sum, you've got the money in hand in an account, and you can take money from it, as you need, whenever you need to, monthly, however you want to do it. It's your money. You've got beneficiaries on the account. It's yours. If you take the annuity, you're essentially giving up your principal. You're giving up your money to MetLife in exchange for a monthly payment. So it just depends on what's most important for your situation on which one of those you're going to do. So this was an actual example. So this person had $75,000 in their ASA account, and when they retired, had they given up the $75,000 for the annuity, MetLife would take the $75,000 and then exchange would pay them about $365 a month for the rest of their life. Or, this person could have essentially taken the money, put it into a retirement account. Now they've got the $75,000, and just as a rule of thumb, you could draw out about $250 a month off your $75,000 and really probably not deplete it too much over time. So that's kind of taking the money and then just really living off the earnings. So you take a little bit less per month, but over here, you've got your money and you're living off, the interest basically. Whereas over here, you don't have the money and you're receiving a monthly payment. So it just depends on what's more important to you at the time of selection.
What's the formula for determining how much is in that ASA balance?
Well, so everyone's different. I mean, they've been putting 3% of your pay into it since you've been working, and you've had it invested however you've had it invested. So it just depends on how long you've been here and how it's been invested, basically.
And then if you go with MetLife and you die after a year, what do they do with the money?
this is where it gets a little complicated. So and you can go on, or we can help you go on to the INPRS website, and there's a MetLife annuity calculator. You can run an annuity option, but when you make this selection, you have all the same options as you have on your original pension. Do you take a survivor? Do you don't take a survivor? They also give you an option of doing what they call a cash refund. So one option is going to be just what they call a single life or straight life option. They're going to give you the most per month if you take that option, but then there's nothing left for anyone when you die. So it doesn't matter if you live 1 month or if you live 30 years. When you die, no one gets anything. If you take the cash refund option, basically they guarantee that you're going to get at least $75,000 out of there in this case. So if you start with 75, you give them 75, and you die before you've collected $75,000 worth of payments, they'll pay the difference to a beneficiary.
What if you live 50 years?
Then you get, the monthly amount every month, because it's a lifetime thing, so you get the monthly amount every month for the rest of your life. Or you can do a joint life, where you and your survivor both receive the payment. And the amount of money you're gonna get is gonna depend on which option you take. But you can go on there and run those calculations and see, again, for you, which makes the most sense. Everybody good with that decision? I mean, that really is something, when you're getting ready to retire, you should absolutely go on there or sit down with Wayne or I, and we'll help you. And we'll go on there and run that calculation so you can make those determinations for your situation. Okay, so this is how you check your INPRS account. That's the website, in.gov/INPRS. When you go there, you can manage your annuity balance, you can select how it's invested, and you can run estimates for these survivor pension calculations and annuity calculations. The first time you log in, you have to get a PIN number from them. So if you go to that website, there's a login button, and then there's a register now button. You gotta click the register now button, and they will send you a PIN number, and then you use that PIN number with your social security number to create a login. And that's something that you should all get a login for sure. And then, if you meet with one of us, we're gonna have to use that login to get in there to be able to run these estimates for you. Okay? All right, so that's it with the state retirement. This next one is the corporation retirement account. So that's the 403B plan. And the 403B plan is made up of a 403B account and a 401A or supplemental account. So the only difference there is the money that goes into the 403B is money that you all contribute. It's an elective thing. You can put how much you want to put into the 403B. And then Franklin will put a match in, if you're eligible for it, into the 401A. This is the website. It's benefitwebaccess.com/retirement-horizons. The 403B is all through Retirement Horizons. They're the administrators of the 403B and 401A plan. And the first time that you log in, you use your social with no dashes as the username and the last four of your social as the password. If you have issues getting in, let us know, and we can have Retirement Horizons reset your login information. As I mentioned, the employee contributions, your contributions go to the 403B side. The match goes into the 401A side. You can put money into the 403B as either pre-tax or Roth. So, the difference there is pre-tax, you're not paying tax on it now when it goes in, but it grows tax deferred, and when you pull it out, it's taxable income. And the Roth is an after-tax contribution, so it comes out of your paycheck after it's been taxed. So you don't really get the benefit of it today, but then it grows tax-free, and when you pull it out, you pay no taxes. I'm a big fan of Roth. I mean, again, it depends on your situation, and age, and how close to retirement, all that stuff you are, but generally, I'm a pretty big fan of Roth, especially the younger you are. The younger you are, the more sense to me it makes to do Roth. All employer contributions are going to be pre-tax contributions, and when you pull that money out, you will have to pay taxes on it.
You can't put as much money in a Roth every year as you do your IRA though.
Well, so the limit on this now, since it's a 403B, is 19,000 if you're under 50, and it's 26,000 if you're over 50, and that doesn't matter if it's the Roth or the pre-tax, it's the same. So you and Bill learned something today.
6 or 7, yeah, 6 or 7 for Roth.
That's an outside.
That's if it's a Roth IRA, but since this is a 403B, it has higher
Okay.
methods.
Good to know.
Any questions on the 403B? So there's 2 times a year, you can change this, April and October, you can change the amount you're putting in. Franklin puts the match in once a year, sometime during the summer typically, and then your contributions go in every pay. And, you know, there again, several different investments you can pick from, and when we come around to the different buildings, you know, in April and October, just sit down, we'll kind of help you figure out how your money, you know, should be invested based on your situation. All right, you want to do Social Security?
Yeah. Unless you want to.
No, we'll turn it over to Wayne to do the rest of this.
He just doesn't understand this.
Yeah.
this part.
Right.
So Social Security, 1935, that's how long this program's been in place. It was put into law by FDR. At the time Social Security was put into our society, you had to be 65 to claim it. A lot of you guys know we can take it a little bit earlier than that now, but at the time, life expectancy was only 61. So you really weren't even, half the population wasn't even supposed to be alive by the time they could claim this benefit. And obviously today, Social Security, we see it's a pretty big piece of everyone's retirement. So we're gonna talk about the system and going broke and all that stuff. I'm gonna explain that to you a little bit here in just a few minutes. So we put this in here. Ida Mae Fuller was the first Social Security recipient. That is actually her getting check number 1 out of her mailbox. And Ida Mae Fuller was also a school teacher out of Illinois. She retired as a school teacher and went to work at a local law firm as a secretary for 3 years. And she paid in, she paid in $24.75 total for that 3-year period. Her first check was almost the total that she had paid in. And she actually lived to be 100 and collected almost $23,000 out of the system. So this thing was doomed right from the very first recipient. So the math didn't quite work out. So like Ryan said, your pension is based on your highest 5 years. Social Security is based on your highest 35 years of earnings. Now it's not just your straight earnings either. They take all of, you guys remember getting the statements in the mail and you'd open it up and you'd see all the money you've made all these years. Basically what they do is they take all of those earnings and they inflate them to today's dollars. So you know if you made $18,000 back in 1980, that's worth about $60,000 today. So that's how they do that. They take 35 years, inflate it to today's dollars, and take your highest 35. And that's kind of what goes into the equation to calculate your benefit, if you've ever wondered that. That's important because if you have some zeros in the equation, do you guys remember from the middle school math? It could maybe benefit you to work and replace any zeros with something. So that's something to keep in mind. For higher wage earners, like all the school teachers in Indiana, only the first $137,700 you make this year is taxable according to Social Security. So if you make over that, you're only paying your 6.2%? Yeah, 6.2% on the first $137,000 you make. And this is individual. So if you have 2 incomes coming in, each of you are going to pay the 6.2% on the first $137,000. This is what you've seen on your statements. You always see what at age 62 how much you can collect, at age 70 how much you can collect, and for most people it's between age 66 and 67, depends on what year you were born, on what Social Security calls your full retirement age. Okay, now full retirement age is the age in which Social Security says you reached your agreement, your full retirement age, we're going to pay you 100% of what we've promised that we would pay you. If you take Social Security early, meaning any time before your full retirement age, there's gonna be a reduction in your benefit, and it's a lifetime reduction. So in our example here, this is somebody whose full retirement age was 66. They were gonna get $22.30 a month, but had they started at 62, that was gonna be reduced quite a bit. And this reduction is for the rest of their life. They get to take the benefit longer, but they're gonna get a lot less per month. It doesn't go up with each birthday or each month. It's gonna be a lifetime reduction. On the flip side of that, the longer you wait to take Social Security, the higher the benefit's gonna be, and that is also for the rest of your life. And that does play a role in some of the planning here, and I'm gonna discuss that too as we roll down the tracks. So why would someone wait to take Social Security later? So the first thing we'll talk about is spousal benefits. So in a lot of cases, there's 2 Social Security checks coming into the house. When one person dies, one of those checks passes away with that person. The highest check is gonna stay. So oftentimes, we're talking to couples about potentially getting at least one earner, and if beneficial, it'd be the higher wage earner, to wait as long as possible to apply for Social Security and take it. And there are some methods to get you there, which we'll discuss. But that way, when someone passes, we still have a higher benefit that does stay in the home. So that's one reason why someone may want to stay working or delay taking Social Security. Another reason someone may want to delay taking Social Security is because of a cost of living adjustments. So does anyone know the answer to this? I know Bill does. Bill, you're not eligible to answer this. If you start taking your monthly pension from the state, and let's just say that monthly pension is $1,500 a month this year, does anybody know how much that benefit's gonna be in 15 years?
$1,500.
It's gonna be $1,500. You're not gonna get a monthly pay increase from your pension, whether it's PERF or TERF. Social Security, on the other hand, does give you annual adjustments based on an index. The average since 1935, I know that's hard to see right there, has been just under 3%. So the longer you wait to take Social Security, the higher your amount is. Then every time you get a raise, it's a higher raise because it's a percentage based on that amount you're receiving. So that's another reason to potentially delay taking benefits. And you can see here, this is at 2.8%. So let's say you started out at 2,000. In 10 years, look at your benefit, 20, 30 years in retirement. I mean, your benefits, almost doubled here just from cost of living adjustments over time to help you keep up with, your big inflation number in retirement is your health care. So that's gonna be the thing that's exponentially getting larger and larger. So that's gonna help you keep up with that. Taxes are another big deal. Your state pension is taxed on 3 levels. You're gonna pay federal taxes, you're gonna pay state taxes, and you're gonna pay local taxes on your pension. Social Security is not taxed at the state level, not yet. Not taxed at the local level, not yet. And only a part of your check is even taxable at the federal level. It just depends on what your overall household income is. And if your income's low enough, which doesn't usually pertain to public employees because you do have a pension and some other assets, it may not be taxed on the federal level at all. But maximum, so we just compared a pension, pulling money out of your investment accounts, and Social Security. Let's say that you were getting $2,000 a month gross from each one of these. Your pension, you're gonna pay federal tax, state tax, local tax, same with an IRA. So here's what goes into your checking account each month. But you can see the Social Security, not all of it's taxed at the federal level. This would be the maximum on this example. No state, no local. So your check's actually about 8% more per month. Same gross income, more per month net to you. So that's something to keep in mind and maybe a reason to wait as long as possible to take Social Security if that's gonna make a difference in your overall plan. Full retirement age, let's talk about that. So, for a lot of you, full retirement age is between age 66 and 67. A lot of people retire before that age, and they say, hey, I'm gonna retire, I'm gonna take my Social Security right now, and I may even work part-time or full-time or sometime. Social Security says if you retire and you take your benefit before you're eligible full retirement age, then we're gonna penalize you if you go out and earn a substantial income. And that income this year is if you earn over $17,640, Social Security is gonna start to take back some of their benefit they're paying you. For every $2 you make over this amount, they're gonna take $1 of your Social Security check back for the year. Okay, so I'm better with round numbers. Let's round this up to 18,000, okay? Let's say you go out, you retire, you're under full retirement age, and you go out and work a job and you make 20,000. So you just made $2,000 over the limit. Your penalty with Social Security is $1,000. So next year, starting in January, they're gonna withhold the first $1,000 that they're supposed to send you to recoup that money back, and then they'll start sending you your checks again. That's how they get that money back from you. They just withhold payments to you. Okay, you don't actually have to write them a check or anything. The only provision to this is the year you are turning full retirement age. Actually, let's go back to this one. We have a lot of teachers. Ryan and I work with teachers all over the state and a lot of school staff, and the school years end in May, right? Most everyone retires in June. You've already made, some people have already made a substantial income between January and June. And then they retire, and then they want to take Social Security. Money you made before you actually file and get your check, or before you retire, doesn't count toward this limit. Okay, so if you made $30,000 between January and May, and you retire in June and start collecting Social Security, and you're not full retirement age, that $30,000 you made does not go against this $17,640. It's only from the time you start to collect forward. The year you turn full retirement age, you can actually earn $46,920 that year. So you can earn it and collect your Social Security early. So this would be somebody that turns full retirement age is 66 in 8 months, but they go ahead and start taking Social Security in January, but they work until May. They made $30,000, but it's the year they're turning full retirement age. So maybe for that first 5 or 6 months out of the year, they were able to earn a full income and collect Social Security and not be penalized. So that's where we see this come into play. So if you're turning full retirement age and you're still working that year, it may be worth a double dip or at least checking, doing some planning to see if that fits what you're looking for. You guys have probably all heard about spousal planning and collecting off my spouse, divorced spouse, widowed, all those things. And a lot of those things are still in play, but a lot of them have also gone away. If you were 62 or older on this date, you should talk to us. There are some planning things that are special for you. I won't go into those here. If you've been widowed and were married at least 2 years and you didn't kill your spouse, then you should talk to us. If you're divorced and you were married 10 years or more, if you were divorced and then your ex-spouse has passed away, definitely talk to us. I had this one today in the office. If you're disabled, a spouse or former spouse was disabled, or if you have kids that are disabled, you need to talk to us. If you have younger children and you're 62 or older, you should definitely talk to us. There are definitely some planning things there that you may or may not know about. So these are a couple of considerations to think about. So why waiting in some households makes a huge difference. These are just kind of a recap on why wait. It's a higher survivor benefit, lower taxes, you get bigger pay raises, and oftentimes the more of your income you can get to be driven by pension and Social Security, the less you have to rely on the money you save. So this is huge. You know, and oftentimes we can use a little bit of money maybe to help fill the gap for a few years, knowing that you need so much less of that money from maybe age 70 on or some age on. So it's a little easier planning actually. Social Security's going broke. Has anybody heard that before? Here's what that means. 1935, we were booming with workers, and we didn't have a lot of retirees. So there were actually, okay, so all of us right now in the room, every time we get a paycheck, we pay 6.2% of our income in Social Security tax. The employer also pays 6.2%. So it's 12.4% tax of every dollar that you guys earn going into Social Security. Okay, that's the tax revenue Social Security receives. It's a pay-as-you-go system. So back in 1935, there were 40 workers paying into Social Security for every one person receiving a benefit. That was more than enough tax revenue to pay that one person. The excess money went over here into this huge fund. It became the largest trust fund in the world, the Social Security Trust Fund. Now, today, people are living past 61 years old. Now there's only about 2.5 workers paying in for every one person on benefits. That's only enough to pay about 75% of that one person's benefit. So the shortfall or the excess is coming out of that trust fund. So the excess is coming out of that trust fund, and it is depleting that. So if nothing changes, we will see this trust fund go away. And if it goes away, this right here, the 75%, is anticipated to stay in place for the next 50 years. So the worst case scenario for people facing retirement right now is that you can count on about 75% of what's been promised to you. That's your worst case scenario. There's going to be some things that are going to fix this. We're probably going to see the tax hikes are the most popular thing that we see being passed through the House right now. A slight increase in tax would fix this thing for 50, 60 more years at least. We're seeing hiring freezes at Social Security. They're at the lowest employment they've had with the Social Security office since 2013. So they're not hiring any new people. Increase in taxable income. So that first $137,000, you know, we've had a lot of wage inflation over the past several years. So if that number just went up to maybe 200,000, that would be enough extra tax revenue to fix a lot of these problems. And means testing, so our Medicare system is already means tested. If you have a higher income, you're going to pay more for Medicare. We could see something like that with Social Security for sure in the future. We already see it in Austria and other countries around the world. They do means testing for their government-funded programs. So there's definitely going to be some fixes here. I wouldn't worry about it too much, but I would definitely make your vote count. But right here, you're looking at your worst-case scenario. And that's from the Social Security Trustees report that just came out. You guys want to see a sample retirement? I can't see it. So this is a sample retirement. Okay, so here's our, we've got a 65-year-old, 35 years of service, and a high five salary average of about $62,000. So this is what retirement looks like for this person, okay? That person making $62,000, their after tax and after insurance income was about $3,200 a month. That's what was going in the bank account each month after settled taxes and health insurance. The pension for that person is going to be about $1,750 a month, and this is after taxes, and that's a straight life benefit. Social Security for this 65-year-old is gonna be another $16.50 a month after taxes. And the investment income, we assumed about $200,000 between all of the different sources together. That's gonna generate another $535 a month of investable income each month. So most of our public employee retirees are gonna get these three pieces of income. These are the three checks you're gonna get every month in retirement. Okay, now the numbers are gonna vary for everyone depending on how much you've earned, how much you've saved. But this is, you're gonna get these three checks, everybody in the room. All right, now, Medicare, and we may let Josh talk about this, but an all-in Medicare cost, the Cadillac plan this year is about $300 a month per person. All right, so we've got after tax, after health insurance, this person's take-home pay is actually gonna go up in retirement versus what it was while this person was working. And we do see that quite often, especially if you get up there in that 30, 35, 40 years of service. We see that happen ever so often. So it looks pretty good. For retired public employees, it looks pretty good. Belch, you wanna do the insurance or you want me to do it? Or Josh, do you want to do it?
Josh do it. Sure. You want to talk about it? All right.
We'll let Josh. Josh is our Medicare specialist at the office. So obviously we work with a lot of retirees and health insurance and Medicare is a big deal. So we brought Josh on several years ago to kind of counsel. I mean, these rules are always changing, and Ryan and I are investment and pension and Social Security guys. And so we brought Josh on in our office full-time just to talk about health insurance. A lot of people retire before age 65. He helps with that. The school's got a great plan too. But definitely at 65 and older with Medicare, Josh does a great job. I'll let you talk.
Sure.
Yeah, we won't go too, we'll keep it brief, but, so if you retire before age 65, the school will help supply you with kind of a health insurance piggy bank called VIVA. This will help cover premiums leading up to Medicare age. Sometimes we see enough people have enough money in their VIVA it carries over to Medicare, and they can pay their Medicare premiums with that money as well. But typically that happens when you retire before age 65. Once again, Medicare is for people who are 65 and older, right? So we're seeing a lot of people nowadays work at least until age 65 to help maybe cover a spouse and to help pay for insurance. Because if you haven't looked at health insurance premiums, if you don't have benefit through an employer, it can get pretty pricey. So, but that's where the VIVA comes in. That's a great benefit for teachers who are retiring. But essentially, Medicare, what Wayne was talking about, something to think about for you. Like I said, I'll keep it brief. Medicare consists of three parts, A, B, and D. And the Cadillac, the $300 a month is Medicare with the supplement and a drug plan. Have you heard of that? Maybe you've heard of that. So that's the most, that way of doing it is gonna have the least amount of out-of-pocket costs for you. If you have an inpatient hospital stay or a surgery, you're gonna pay the least out-of-pocket. The cheaper route can actually only cost you about $150 a month. An Advantage plan, you may have heard of that, I don't know. But an Advantage plan will only cost about $150 a month in premium, but you're gonna have more out-of-pocket expense as you go. So it just comes down to your personal situation and how you wanna go about managing your out-of-pocket expense when it comes to the health insurance side of things, and just kind of managing that side. But
So with the Cadillac plan you mentioned, right now it's around $300 a month. How much does that go up on average?
So supplements do increase every year based on your age. Typically those increases they'll jump up $5 a month on you every year.
Okay. So if I was gonna retire in 10 years though, what would that 300 look like at that time, do you think?
3,000.
It's a good question. As far as the cost of.
Yeah, and is there a trend? Does that usually go up 2-3% a year?
No, I haven't seen that. I mean, for a 65-year-old male, you're probably looking at about $110 a month for the Cadillac supplement. For a female, $95 a month. Females cost less.
Okay.
Those guys.
And with that Cadillac, you've got the supplemental. So if someone goes into the hospital, do they have any out-of-pocket expense?
$198. You have a
$198
$198 deductible for the year. That's it.
for the year.
Yeah. Yeah.
Cool.
So yeah, a lot of people like that route, but but then there's some people who they're healthy as can be. You know, they've been used to a big deductible all their working life, so an Advantage plan doesn't really scare them. Like, I'll go with an Advantage plan, save that money in premium, if something comes up, I'll pay the bill. Like I said, it comes down to your personal preference. So, and if you are, a couple things about enrollment. If
Josh,
you're-
real quick, go back to that though. So you got the healthy person, right? You've been healthy your whole life, and you take the cheaper plan. You may not be able to go to the Cadillac plan. Something, all of a sudden you come down with cancer or diabetes or something. You can't just, the first time you enroll in Medicare, it's wide open. You choose, there's no qualifications. But once you choose, you may be stuck there. So that's, it's a big decision.
Yes, just like all these, like Wayne and Ryan have been saying, with your decisions you need to make as far as how you're gonna take your money, your pension, you definitely, I would encourage you to sit, with me, or if somebody you know that does this, sit down with somebody and talk about this side of it, your personal situation, and then you can make the best decision going forward. So that's a good point. It's definitely good to consult with somebody like myself or somebody that you know that does this. And as far as enrollment, if you're retired before age 65 and you're taking your Social Security benefit, you're going to be automatically enrolled into Medicare. All right, you're going to receive your Medicare card in the mail. Okay, but if you're past 60, if you're not taking your Social Security benefit and you want Medicare to start when you turn 65, you have to go to Social Security and enroll yourself. Okay, does that make sense?
Is there any reason why someone would not want to enroll on this?
If you're still working. So so say you're still working,
And you're getting
you're
help.
on the employer plan.
Gotcha.
Typically the employer plan is going to be cheaper than, especially with school corporations. It's definitely way more cost effective to stay on your employer plan as long as you're working. There are some situations where, people with their benefits to have their spouse on their plan, it goes way up. So it can make sense that, hey, your spouse is eligible for Medicare, get off the employer plan, go on to Medicare, and you stay on. It just depends. Once again, it's not a one-size-fits-all, so feel free to give us a call. I'll sit down with you. We can run the numbers and look at the situation and help you out in that regard too as well.
They have an HSA plan here too, Josh.
And you have HSA, so that's huge. I would encourage you, everybody I meet with that's still working, that's on those latter years of retirement, like closing on retirement, if you can put money away in your HSA, do that. That's the trifecta. They call it the trifecta. It goes in tax deferred, can grow tax deferred, and then it can be taken out tax free as well. And you can actually use HSA money to help pay for Medicare premiums. So you're kind of creating, not only may you have a VIVA account, but then you can also create your own little special health insurance piggy bank as well with the HSA. So,
Dumb question probably, but so do you put into that HSA
yes,
yourself?
that is. Does the plan here contribute to the employer or HSA?
There is going to be a contribution this year
Okay.
for those who switch to the high deductible health plan, and also those who are already covered. It is not something that is guaranteed to happen every year.
Okay. But yes, but for the most part, essentially, you're going to be the one that's putting in the bulk of it.
Mhm.
Yeah. But that's definitely a good idea to do. So.
Do you advise doing that if they've not been in an HSA and they're 62?
Well, you have to, so to have an HSA account, you have to be in an HSA compatible plan. So correct. So the only way you can have an HSA fund is if you're in a plan that is compatible with it.
Gotcha.
Yeah. And that's pretty much the most part. Like I said, we won't go too in depth. I do put on a seminar every month about this stuff where I go deeper into this stuff. So you can send you all out an email about that as well. So.
So this is just another little advertisement for our, that, for the workshop that we'll have